Hi, Remoun Said here, talking about the 4 C's of lending. Now, these 4 C's are what banks will look at to see if they're going to give you a loan or not. Now, these 4 C's break down into these 4 words that start with a C. First is capital, next is capacity, third is character, and then followed by collateral. Let's talk about capital. Capital is obviously your savings and your assets that you have that you're going to bring into the deal. Now, this will consist of your down payment and also extra money for emergencies. So banks are going to look at that. Next is your capacity, which might be one of the more important C's, along with character. Capacity is, can you pay the debt at the end of every month? So the way you demonstrate that is obviously with a job. So if they see that you've been making and you've had the same job for some time and you make X amount of dollars, typically they know that in the future you're going to probably be making the same, right around the same amount, if not more. If you have inconsistencies, you go stay at a job and you have a month or two break where you're not working, and you go on to the next job, it's not going to look as good. So they're looking for consistency, especially in the capacity portion. So the same employer, or at least employment, and what they're going to look at for over a 2-year span. Next C is character, and this will be your credit report and your credit score. So it's really important when borrowing money to show your credit worthiness. And if you haven't watched the credit video yet, please do so. This will go in more detail on how credit is actually analyzed and ways to improve it. So the third C is character, which is your credit. And the fourth C is collateral. Banks always lend on collateral. They're not going to lend money because they like you. They lend because there's an asset there. And if something were to happen, they have the asset backing up the money. So with that said, to demonstrate each of the following, you're going to need certain items that we're going to be collecting from you. The first is going to be 30 days worth of pay stubs, and that's going to demonstrate your capacity, which is your job. Followed by is your taxes, and that has a part to go with also your capacity as well as your character, that you're filing taxes, you're making money over the last couple of years, you're not writing off the world. 2 years of taxes. Next is your asset statements, which goes to your capital, making sure that the money is in the bank and you've had it for a while. They sometimes look at the average and see how long you've actually had the money in there. It hasn't been deposited in the last week or so from a family member and so forth. Next is your employment history. Also, with the pay stubs, looking at your capacity and making sure you're able to keep a job or hold a job for a certain period of time, or if you lose your job, being able to get a job fairly quickly. Next is your rental or your resident history. Typically consistency is really what wins banks or what wins them over to your side. And if you're hopping from apartment to apartment every 3 months, that might go against you. Where if you've been in the same place for 5 years, 10 years, they see the consistency there, and they like that. So they're going to ask for some sort of proof that you've been renting, or you've either apartment or house, and that they'll probably talk to the landlord and make sure that you're fairly, for the most part, always on time with your payments. And the last part is a property info, and that usually comes from the appraisal, and that will cover the collateral portion of the C's. So they want to make sure whatever they're going to lend on is what it's worth. So typically, a lot of people, big question that comes when it comes with these the collateral on the appraisal is, well, I'm buying a house for $300, but it's appraises and it's really worth $350. Am I allowed to take that extra $50,000 and do stuff with it for the house? And the answer is no. The bank is only going to lend to you the appraised value or the contract price, whichever is less. So since the contract price might be $300, but the appraised value is $350, they'll only lend you up to $300,000. So with that said, that explains the 4 C's of home buying. If you have any other questions, feel free to keep browsing around these videos. Somewhere on this site we'll have a section where you can subscribe to our videos, make comments, follow us, and so forth. On the bottom you can click on our LinkedIn icon or Facebook and so forth. So thank you for watching the video on 4 C's, and look forward to having you either at a workshop or meeting you in person. Take care. I'll talk to you soon.